how do risk assets fare in the light of conversations around recession? Because clearly they are not too bothered about it. And more importantly, the new world order of withdrawal of liquidity, right? In the first time in so many decades. How do you look at it?
So I think, there's a part and parcel of regular conversation, and it's a pretty global conversation, is people are worried about a slowdown. But just look at the world between the first half of 2022 and the second half of 2022. In the first half of 2022, the largest economy in the world, US, had an annualized growth of minus 1.2%. The second largest economy in the world, called China, had a minus 0.5% annualized rate. Now, whatever concerns you have about COVID, zero COVID policy in China and continued lockdown, etc., in 22 second half, China is going to post a higher growth rate than in the first half. And the largest economy in the world, US, is also going to post a higher growth rate in the second half. So roughly 50% of the global economy is going to grow stronger in the second half of the year. Europe will go through a bad time, but estimates are becoming, as you spoke about, shallower and shallower recession rather than deeper and deeper recession, given that fiscal policy has been brought to the forefront. Then there is the rest of the world, which is emerging market ex-China, and clearly there's a slowdown, and the slowdown over there in the second half of the year is going to be in Latin America and Europe, largely because Latin America and Europe are now going to pay the price of the massive tightening, monetary tightening that they did. Monetary tightening takes 6 to 9 months to have an impact, and that's when we feel that the impact is going to be felt. Asian emerging market ex-China isn't going to do that badly, probably depends on how much China, but probably going to scrape through with a reasonable amount of growth. So the world isn't really going into recession and slowing down as yet.
Okay.
But that's not very good news, and I'm going to come to asset market. It means that the central banks are not going to start easing anytime soon. In fact, there's a central bank called the Fed next week. This week.
This week.
Yeah. Probably going to come up with a hawkish tone, and not only hawkish tone about hawkish action, but a hawkish tone. ECB, if the recession is not shallow, ECB is going to likely to continue to raise rates. If you have that amount of fiscal expansion taking place in UK, Bank of England is probably going to keep on raising rates. And the impact of all of that is going to be felt by emerging markets who so far, particularly in Asia, who so far haven't really raised rates very much, will be pushed into raising rates. We'll see what happens, what RBI does. So my point is that risk assets are now looking at, recession fears would have led to, recession fears will lead to central banks easing. Recession fears are fading, at least for 2022. Maybe in some point in time it will come back again, which means that the central banks are going to probably be much tighter. And there isn't any rate cuts and things like that people were expecting. So I think asset prices, both the equity side and the bonds and bond prices, will have to react to that. And I think that so far the market doesn't look as if, at least not the bond market, not the equity market, doesn't seem to getting that there is no recession implies that rates are going to be tighter, and what it does that to equity prices. Bond markets so far, I know the 10-year has moved up in the last couple of weeks' time. The curve is still inverted. So yes, the bond market is probably accepting the fact that probably the recession is not going to happen immediately. And I think the bond market very quickly will also start pricing in that there isn't any rate cuts in 2023. I think, this week we will get to know how the FOMC indicates in that direction. But that's the way we are looking at it.